Transfer pricing is a relatively common international tax strategy that both big companies and small companies that want to reduce their taxes can use to their advantage. But as with so many offshore tax concepts, there are misunderstandings and misconceptions about what transfer pricing is and how it works. And so today, I'm going to tell you what it is and a little bit about how you can use it in your company. Hey guys, I'm Andrew Henderson. Here at Nomad Capitalist, we help 7- and 8-figure entrepreneurs who have small businesses go where they're treated best by legally reducing their taxes. We also help them build their options through things like dual citizenship, take advantage of lifestyle and investment opportunities in new boom markets, and just generally go where they're treated best. You can learn more at nomadcapitalist.com. Now, transfer pricing is basically the movement of monies between two commonly related or commonly owned companies. It's as simple as that. Now, there are many different ways to do this. And in this video, I'm going to give you a basic introduction. We're not going to go into super advanced techniques, partially because there's so many different ways to do it. I'm not giving tax advice. There's no way I could just talk to any one particular situation. And I happen to run a business that does this stuff, and the nomad's got to eat. But basically what we're talking about is, let's say that you are Google, for example, or any big multinational company. You've got offices around the world. You've got intellectual property. You've got people and assets and human capital, all these things in different places. And you need to find a way to move money between them. So you might have an office in Germany, for example, and you have a German company because you're doing some work in Germany. But how do those German workers get paid? You may not be booking your sales through that German office because there may be a more tax efficient way to book sales from advertising, for example, through a different place in Europe. And so there are lots of complicated rules that get imposed in most cases of how to move money between two places. But generally speaking, it's if you own company A and you own company B, how do you get money between those companies? Now, back in the early days of Nomad Capitalist, when I was first talking to people, and even back when I was hosting conferences with people like Peter Schiff and Jim Rickards, people would come up to me and they'd say, Andrew, I've got a great idea. I'm going to start my offshore company in the Seychelles, and I'm going to, put all my patents of that company, and then I'm going to keep running my current business in the United States, and I'm just going to send all the profits to the Seychelles and pay no tax. Now, obviously, there are a lot of issues that also come into play, such as controlled foreign corporation, permanent establishment, all kinds of different rules that govern where a company is taxed to begin with, right? If you live in the US or Canada, your foreign companies and tax havens are not going to be treated with tax haven treatment. They're going to be taxed as local companies. But from a transfer pricing perspective, there are a lot of misconceptions in that you can easily just put some tiny asset in an offshore company and just suck all the money out of a company in a higher tax jurisdiction and therefore achieve tax savings. Now, what I would say for the average small business owner, even if you are in the 7 or 8 figures, in many cases, I see people where you don't need to use transfer pricing. If you choose the right operating entity and you follow my tax-friendly or tax-free quadrant where you're getting your personal tax situation and your business tax situation figured out correctly, you may not need all this complication. I think sometimes people come because they read an article in the Wall Street Journal about how these big companies work, moving money all around. I can tell you, when I first started, it seemed pretty sexy to do that. Now I realize it's a pain in the tuchus. You don't want to, if you can have one company and that solves your problems and that gives you asset protection, it gives you low tax and it keeps everything running, like that's enough. Or maybe 2 companies. But for a lot of folks, that's the most important distinction. You don't even need transfer pricing. But if you have staff in a different country or different countries, for example, especially if they're in high tax developed countries, if you have staff in the United States, you may need to do some transfer pricing to make that work. Or if you have staff in Australia, you may not want what's happening in that country to affect your entire company. And I've often worked with people where they'll have 100 employees globally, and the owner will be living in a tax-friendly country, like let's say Thailand or Panama, and yet they'll be running a business with 10 of those 100 people on the ground in the United States, and they'll be running the entire business through a company in the US. And I'm thinking to myself, 90% of the work, plus the owner, who's theoretically worth more than the average employee in terms of his output or her output, 90% plus of the work is being done overseas, yet why are we doing all the work in the United States? And so what transfer pricing from my perspective allows you to do is give each part of the value chain its own company and move money freely. And so if the company in the United States only contributes 10% of the value, it should only receive 10% of the profits, and therefore your taxes could go down by as much as 90%. Now that's a simplification, but things like staffing, things like intellectual property, those can all be ways that you can move money around the world. Sometimes you're going to move money into a high tax jurisdiction, often you're going to move money out. What again I see people struggle with though is, big companies like Starbucks use IP offshoring, where they put patents and trademarks and stuff offshore and then they charge themselves royalties. Most small businesses don't really have the opportunity to do that. In fact, I've seen companies, tech startups and other startups that literally have 9 and 10 figure valuations that we've worked with. And in many cases, they don't even do this. Right? In many cases, they'll have 1 or 2 companies, maybe one does billing, one does operations. They're not even outsourcing or offshoring their IP. And because most companies just don't have the IP to do it. A company like Starbucks does, right? Big household names do. Your website does not. And I've seen some very micro examples of selling a website, for example. I mean, there could be some general small intellectual property, but that often doesn't really come into effect, right? You can generally achieve greater tax savings by doing other things. And so transfer pricing is something that you want to be aware of, okay? Advanced transfer pricing tends to get expensive. And so if you're not running a big company, I'll often try and help people avoid it if they can. Maybe that means moving a couple people out of one office and somewhere else offshore. Maybe it means setting things up in a bit of a different way because sometimes a transfer pricing study, a good one for a big enough company, could be $50,000, $100,000, even $200,000, right? And so if you can avoid that by just structuring your company and structuring the lives of the shareholders correctly to make it easy on yourself, you're going to save a lot of money. So it definitely plays a role in moving money as you have global operations. But the flatter you can make your structure, the simpler you can make your operation run, the fewer shareholders that are involved also means less transfer pricing is involved. And that's, again, really important also because more and more countries, as well as international organizations like the OECD, are trying to really establish very strict rules for transfer pricing. Obviously, they don't want 90% of the money leaving their high-tax country and going to a low-tax country. And so they're closing all the exits there. Many of the exits have already been closed, and they're looking for more to close, right? And so you really need to get your ducks in a row if you're going to be doing transfer pricing. But that's kind of an introduction to how it works and what you need to know. How can Nomad Capitalist help you? 4 ways. Number 1, subscribe to our channel and click the notification bell to make sure you get our new video every day. Number 2, get a copy of Nomad Capitalist, the book. You'll learn a lot of my personal experiences over a dozen years of studying this stuff, as well as exactly some of the strategies that you can use to build your Nomad Capitalist plan. Number 3, if you're not sure where to start, but you want to come and learn from my team and I, you want to come and mingle with like-minded people, learn more about our live conference, Nomad Capitalist Live. It's coming up soon. And number 4, if you want some help right now because you've got a burning issue, you need something solved, you want to lower your taxes, get a second passport, or build the Nomad Capitalist lifestyle of your dreams, go to nomadcapitalist.com and click on Become a Client.